In this video, I want to talk about understanding the futures of sector funds for better investing. Sector funds are mutual funds or exchange traded funds that focus on a specific they focus on a specific sector of the economy. They tend to invest in a specific sector of the economy, such as it might be technology, a sector, it might be healthcare, it might be energy, or any other sector. And so here are some key features of sector funds. Number one is focused exposure. Focused exposure. Sector funds are invested in companies within a specific industry or sector, providing targeted exposure to that area of the economy. They choose a particular sector they want to invest in, and then they go ahead and invest in that specific industry. Number three is higher risk and volatility. Higher risk and volatility. Because sector funds are concentrated in one area, they tend to be more volatile and riskier compared to a more diversified funds. The performance of the fund is closely tied to the performance of the sector. In other words, if the sector performs poorly, the fund will perform poorly, and if the sector performs excellently well, the fund will equally perform excellently. Number three is potential for high returns. Potential for high returns. When the sector performs well, sector funds can experience higher returns compared to more diversified funds as they capitalize on growth within that specific industry. If the industry experiences growth, that will impact positively the performance of the fund invested in that industry. Number four is market cycles and trend. Market cycles and trend. Sector funds are sensitive to market cycles and trends. For example, technology sector or technology funds may perform well during periods of technological breakthrough and innovation, while energy funds may be impacted by changes in oil prices. That's how sector performance controls the performance of these sector funds, and it equally have to do with the trends or the market cycle these funds are exposed to. Number five is diversification within the sector. Diversification within the specific sector concerned. While concentrated in a specific sector, these funds typically hold a diversified portfolio of stocks within that sector, reducing risk compared to individual stock investment. We need to understand the fact that these stocks may be invested in a given sector, but yet they will go ahead and diversify, amongst many stocks in that specific sector. So they're not really affected by a company specific risk. Number six is targeted investment strategy. Targeted investment strategy. Investors may choose sector funds to take advantage of growth in a particular sector to hedge against specific risk in their overall portfolio. So when they target a particular sector, they target these sectors based on a given factor, on a specific factor, and this factor could be growth. And so if the factor is growing, if the sector is experiencing growth, then they start to perform very well because the sector they've invested in. Please like this video and subscribe to this channel, so it will encourage me to keep on, giving you contents of this nature that is designed to make you financially literate. And once you are financially adequately, are literate financially, then you will be able to be financially free if you apply, all these lessons learned in this channel. Number 7 is a sector specific risk. The fund performance is influenced by the specific risks affecting the sector, such as regulatory changes, commodity price fluctuations, or technological advancement. All these factors can affect an industry, can affect a sector. So they are exposed to these sector specific risk. For instance, if they are invested in the energy sector and there's this drop in the price of oil in the international markets, it will affect the sector. Number 8 is suitability for tactical asset allocation. When it comes to strategic asset allocation, as a manager, as an investor, you have to consider, these sector funds. So sector funds are often used by investors who want to adjust their portfolios based on short-term opportunities in specific sectors rather than long-term core holdings. If you have that short-term orientation, you don't want to invest for the long term, then you can target a specific sector, a specific sector fund you feel will perform very well because of probably positive development in the sector they are invested in, and that will boost your return, significantly in the short term. Number 9 is expense ratio. Expense ratio. Sector funds have a higher expense ratio than broad market index funds due to their specialized nature. Though this depends on the specific funds. Usually, some funds may charge a higher fee. Some other funds may charge a relatively lower fees. Number 10 is access to niche markets. Access to niche markets. Sector funds provides an easy way for investors to gain exposure to a niche markets or emerging industries that may be difficult to invest otherwise. Some funds specifically targets probably an emerging market, and they may target a kind of secluded niche market. So if you want to invest in all those niches, or you want to invest in these emerging industries, you need to key into these sector funds. They will grant you exposure to those markets. Our investors should carefully consider their risk tolerance and investment goals when adding sector funds to their portfolios, as they can offer significant opportunities and also increased risk. So consider all these things before you make up your mind on whether to invest or not to invest in sector funds.